Hello everyone and welcome to week 2. This week we're going to cover chapters 2, 3, 4, and 5. It may sound like a lot, but I think they're pretty short chapters. There's not a lot of pages to each of the chapters, and they are rather related. So once you learn the information from chapter 2, you're going to carry that over into chapter 3 and chapter 4 and chapter 5. So chapter 2 is on reporting intercorporate investments and consolidation of wholly owned subsidiaries with no differential. And the first learning objective that we're going to study is to understand and explain how ownership and control can influence the accounting for investments in common stock. So how do you account for an investment in common stock in another company? So if you own a company or you have a company and they purchase stock in another company, how do we account for that investment? How do we put it on the books? And that's what we're going to deal with here. So the method that's used for accounting for investments in common stock, it depends on two things: the level of influence or control that the investor is able to exercise over the investee. How much control do they have? How much influence do they have? And that's directly related to how much stock they actually purchase. And then the other thing is certain choices made by the investor of all the available options. And so let's look at this next slide, which gives us a summary of accounting for equity investment securities. And you can see we have a line here. It starts at 0, goes to 100. We have a market 20% and a market 50%. So if the stock purchase is between 0 and 20% of the total stock, then the company has insignificant influence. They really don't control the company or influence it in any way. And so if this is the case, they can use the cost method for accounting for those investments. And these are going to include investments not intended to be held long term, and these are marked to market as trading or available for sale securities. So these securities that we have insignificant influence over would be considered trading or available for sale securities. And then if the purchase is between 20 and 50%, then we would say they have significant influence, not total control, but significant influence. And so here you're going to want to use the equity method. And then if it's 50%, above 50%, all the way up to 100, then we would say that they can exercise control, and they would use the equity method or the cost method. But also they have to use consolidation. That's when you would consolidate the financial statements. And so just a couple of other things to note. The threshold for significant influence, it's normally considered to be 20%. However, it can depend and vary depending on the circumstances. So it's always important to consider each individual case. And then lastly, under insignificant influence and significant influence, you'll notice here the cost method is used for insignificant influence and the equity method is used for significant influence. However, the investor can choose the fair value option instead. And so let's continue to think about this for just a moment. Consolidation, it eliminates the investment account and replaces it with the detail. So again, if you have insignificant influence between 0 and 20%, you can account for as either trading, available for sale, or cost investments. And if we're talking about an investment between 20 and 50%, then you can use the equity method or the fair value option, and we would say that they have significant influence. Anything above 50%, we would use the equity method or the cost method and consolidation. And we would say that they exhibit control. And so why is the cost method okay to use? Well, the cost method, it's used for reporting investments in equity securities when both consolidation and equity method reporting are inappropriate. The equity method, this is used when the investor exercises significant influence over the operating and financial policies of the investee, and consolidation is not appropriate. It's used most often when one company holds 20% or more of another company's common stock. The investment is reported as one line in the investor's balance sheet, and the income recognized from the investee is reported as one line in the investor's income statement. And so then let's consider consolidation. This involves combining for financial reporting the individual assets, liabilities, revenues, and expenses of two or more related companies as if they were part of a single company. Normally, this is appropriate when one company, referred to as the parent, controls the other company, which we call the subsidiary. A subsidiary that is not consolidated with the parent is referred to as an unconsolidated subsidiary, and it would be shown as an investment on the parent's balance sheet. So let's do a little practice quiz. So if Company A purchases 45% of the outstanding common stock of Company B, the investment in Company B should be accounted for A, as an available for sale security, B, as a consolidated subsidiary, C, as a trading investment, or D, as an equity investment method, or E, none of the above. Let's think about it for just a moment. The question doesn't really say why they're purchasing this stock, but typically available for sale, they're not going to buy quite so much. And it doesn't really say why they have it. It just says that they purchased it. So we don't really know if they are trying to exhibit influence or control. We don't really know if they have an idea to sell it. But most of the time, available for sale, they're not going to have such a large purchase. B, as a consolidated subsidiary, consolidation doesn't occur until 50% or more. C, as a trading investment, again, same reason as I wouldn't pick A. They bought a lot of it, and it doesn't say why they bought it. And we know that over 20%, it's typically insignificant, or significant influence. Yeah, significant influence, over 20%. So the next one is as an equity method investment. And if I recall, if we go back a couple of slides, over 20% equity method, significant influence, and it's the below 20% that's accounted for as trading, AFS, or cost investment. So I think our answer is going to be D, an equity method investment. So I'm going to post this in the discussion, and I will include a question in the discussion above the video that you can all answer. And this will get us started this week. I hope you guys have a great week, enjoy the week, and enjoy learning about accounting for investments in common stock. This is one of the chapters I always enjoyed when I was taking advanced accounting. So hopefully you'll enjoy it too. It's fairly straightforward. Just follow the rules, and and learn how to do the journal entries and things like that. And it's pretty straightforward. I think you'll enjoy it. All right, everybody have a great week, and I will see you in the discussion. Thank you.